It's the start of another interview-packed week here at Dukascopy, and kicking things off today, we welcome back into the studio Eric Kohn, Managing Partner at Barron's Financial Services. Welcome back, Eric.
Thank you very much.
Today we're going to talk about private equity. It seems the media frenzy surrounding the global economic crisis appears to have turned private equity into a bit of a buzzword. Are you seeing larger levels of activity, as a reflection of this?
No, and I think you have to define what is private equity first, because the private equity that everyone is talking about is really, to a large extent, leveraged buyouts and buying companies with the management or without the management, putting management in, holding it for a limited period, and then disposing of it, hopefully at a profit, and improving the company while you go on. However, there has been private equity for a very long time in Germany, for example, in Europe. But the difference with that private equity is that there's no time limit. They're happy to take minority and majority participations, so long as they get a reasonable return, either by dividend or by capital gain. And it really, if you translate the German word, it is participation companies rather than private equity. I think the furore around private equity is very much around the model which you buy a company, leverage it up, sit there, hope and assist management to do well, and in 4 to 5 years you sell it on. And you may not even sell it to industry, you may sell it on to another private equity company, who then keep it 4 to 5 years, having leveraged it up, and sell it on to another private equity company. There are quite a few tertiary and secondary deals being done in private equity. So I think there is a real question on the value added as to whether all of these deals where there is leverage in there really do something for the management and for the company. Clearly, if you have leverage, that reduces the tax you pay, and I think there is a focus on the huge capital gains that are incurred in the process. Equally well, of course, there are companies that don't go quite as the private equity company hopes.
Well, we're also seeing sort of higher levels of public interest as well. It was reported in the US that large public pensions are pouring 11% of their total assets into private equity firms. Is that sort of an additional factor to the private equity market at present?
No, I think there is a general situation where if you're an institution or a high net worth person, where can you put your money? Where you've got a reasonable chance of a decent rate of return and not a very high risk. Venture capital, of course, is high risk, high return, and a lot of venture capital companies go down. Equally well, venture capital companies have a problem, especially in the US, that under the tax laws, if the shareholding changes more than 30%, it's a change of control and you lose any of the tax benefits. So people are going into industry, which is what private equity is, into businesses, investing in it. It's really a question of how they invest and whether the private equity company has industrial consultants or partners who understand industry, or whether it is just financial engineering. I think the negative discussion on private equity is all about financial engineering. Those private equity houses, even though they might dispose of it in 5 to 7 years, that really have people who come out of industry that are partners and assist in the process and therefore assist the management, are less criticized.
The recession almost seems to give with one hand and take with the other, whilst there are a larger number of opportunities for investors, because largely companies are requiring that little bit of extra capital at the moment to get them through the recession. At the same time, there must be competition for good companies, therefore, that are going to provide a return.
Well, I think the problem is slightly different. The problem is it is very difficult for good companies to get funding for expansion or working capital. The banks are prepared to lend, but the banks are, certainly if you take Germany or Switzerland, far more restrictive than they were. The savings banks are still prepared to lend, but the bigger banks are very much more careful and have actually curtailed their lending. So if you're a good company and you're looking to expand, or you have a succession problem and you want your management to take it over, both of those sort of situations will go to either private equity, or more likely in Germany, in the case of succession, or in the case of working capital, to a participation company which hasn't got the stress on it to exit in 4 to 5, or perhaps 7 years.
We've discussed, we've touched on a little bit on kind of the negative reputation that portions of private equity seem to be receiving. You've got the discussion with Mitt Romney's Republican presidential campaign has brought private equity industry under intense scrutiny in the US. It's also believed that a weak stock market and a struggling rupee in India is going to provide opportunities. Do you think, therefore, where you've got that split between almost sort of good private equity and bad private equity, it's giving it sort of an unfair reputation?
No, I think the criticism and comments on Mitt Romney is due to the fact in the US gains made by private equity partners are not taxed as income, but taxed as capital gains at a lower rate. And really, when you think about it, the gains they make, it's part of their business. So it is, in the view of a lot of people, income, and they should be paying tax at the same rate as income. In Switzerland, it's probably regarded as income as well. So that's one area where they feel that people have benefited by this tax loophole. In terms of whether Indians coming on in private equity or not, there will always be, especially in a market where banks are not prepared to lend, a need for alternative capital, and there's also a need for alternative assets for investors. So whether it's called private equity or participation companies, at the end of the day, there is a market need because people want a better return, and the companies have a need because they need the capital, or the capital as working capital to expand or to make acquisitions.
That's all we've got time for here today, but do stay tuned for all of your latest trading updates, analysis and interviews here at the Dukascopy TV Centre. But for now, goodbye.